Alibaba is down 29% over the last 12 months and currently trades towards its 52-week low. But is this a strong undervalued buy now that we should consider for our portfolio? As always, we're going to do a deep dive. We're going to take a look at the top line revenue growth over the last 10 years. We're also going to look at the bottom line net income. We're going to look at the health of the company, their total cash versus their total debt. And we're going to take a look at how they've performed over the last few years versus their competitors as well. And we're going to take a look at institutional ownership. Are they buying? Are they selling? What indicators can we see from the large corporations? And a few news articles about some insider buying, as well as some massive amount of share repurchases. And finally, we will get it through, take a look at their financial metrics, discuss their dividend safety and their growth for the long term. And as always, we will run them through the valuation model so we can get to our intrinsic value, lock in our acceptable buy price based on our investment margin of safety. And as always, see what are Wall Street forecasting for this company over the next 12 months. So the first thing to note about this stock is that we can see both Seeking Alpha Analyst gives this a strong buy now, as well as Wall Street. So let's find out if we agree, if this is a very good opportunity for the long term. Now, yes, over the last year, it is down 29%. When we extend this over the last 10 years, we can in fact see real little movement. In fact, it was $94 in 2014, nearly 10 years ago. So it is lower now than what it was trading for in 2014. And we note an incredibly high all-time price of just over $300. And since then, the share price has trended downwards all the way to around $66 not too long ago. Now, it does offer a yield of 1.39% and a forward P that looks incredibly cheap at 8.27. So let's take a little time to dig deep and see what is going on with this company. Now, top line growth, we do want to see a minimum of 3 to 7% and very strong growth from Alibaba from $8.5 billion on their top line in March 2014 all the way to $127 billion in March 2023, their latest annual report. And when we look at it in terms of the growth, it is moving in the right direction, very rapid growth, although we do note a small drop from 2022 to 2023, which we will look at in terms of percentages very shortly. In terms of the bottom line net income, well, $3.8 billion, and they have again increased it very sharply over the last 10 years to around 10.6. But we do want to note a lot of inconsistencies year on year. For example, growth from 2014 to 2016 before decreasing and then increasing all the way to 2021 and then essentially more than halving in 2022. So a lot of inconsistencies that we do know, even though we can see their top line revenue growing, their bottom line net income isn't as consistent. So one thing to factor into your investment thesis. Now, when we look at the health of this company, their total cash versus their total debt, we do see they have a very large cash amount going from $7 billion in 2014 all the way to $87 billion from their latest quarterly report. And we can note from here, it has increased very rapidly, so they do hold a very large position. Now, the important thing here is to compare it numerically and directionally to their total debt, and that is exactly what we're going to do. Whilst their cash has increased, it has gone from $6.6 billion in terms of their total debt to just under $28 billion. So even though their total debt has increased, they have far more cash, so they are able to pay all of that off if they needed to in less than 1 day. And we can see this here. Total debt, it is increasing, not moving in the right direction, but given cash is increasing at a faster rate. No massive concerns at a high overview look, but we will look and factor this in when we look at some other metrics like the net debt to EBITDA. Now, taking a look at other consumer discretionary companies in the broadline retail, we have PDD Holdings, Prosus NV, Mercado Libre, and a few others that are very well known. Now, over the last year, this includes reinvesting those dividends. Alibaba is down 28%, and we can see one of the worst performing in this industry. When we extend it to the last 5 years, we see them again, one of the worst, down 61%. So that is very, very poor. And when we extend this over the last 10 years, down 23%. any investment that you are holding over a 10-year period, if you are down, it is incredibly poor. The one thing we always like to mention is that past performance is not an indicator for future, so something to bear in mind, and hopefully with this analysis we can see whether or not it is worth taking a look at this for the future. Institutional ownership 13.5%. Whilst we see $6 billion worth of sales by the institutions over the last 12 months, we see a little bit more buying, in fact $8.11 billion over the same period, and we do note Q3, Q4 more buying than selling. Q1, again, we don't have a massive amount of data just yet, we will get that very soon, but we do note more selling than buying. Overall though, more selling than buying in Q1. In terms of 2023, we can see a lot more buying than selling, so something to consider for your own investment thesis. Now, before we jump into the financial metrics, look at that dividend safety. Two things we did want to point out. The first one is that we can see the Alibaba co-founders. Now, this was news from the beginning of the year, in fact, the end of January, but it is quite important to note Jack Ma as well as Job, they did pick up more than 200 million worth of shares between them. There was a lot of talk, in fact, about both of them looking to sell shares, so this was a very bullish sign for Alibaba at the beginning of the year. The only thing we would mention was, even since that point, there hasn't been much movement on the share price. When we do take a look year to date, in fact, they are down. So again, do take a lot of this information with a pinch of salt. Don't necessarily believe that just because we have a bullish signal that the co-founders are buying, that it necessarily means the share price is going to go up. But again, something that was of very large interest to us when we did see this information, and it thought it is worth bringing this up again in April 24. Now, the second thing we want to note is that they did make, in fact, just this week, the second biggest ever quarterly share repurchase worth $4.8 billion. This is something I can definitely get behind, especially as we're about to come on the valuation. This does look like a very, very cheap price for this company. And we can see here they bought back more than $4.8 billion in the quarter ended March, the second, in fact, highest ever since they did plan this boost, and they are looking at a buyback plan of $25 billion through till March 2027. So that is quite bullish in my opinion. It does give me faith that management know what they're doing. They see the share price is very low and they're buying back shares. Now, in terms of looking at the dividend safety score, we don't have a rating just yet, given the fact they only recently did offer that dividend, and we do see it is a mega cap company at $175 billion. In terms of looking at the metrics, well, first thing to note on the free cash flow, given it is the first year of dividends, they expect a 11% payout ratio, 2024 pretty much the same. So given it is so low, I would like to think they will offer a strong double-digit dividend increase to their holders, and that is something that is very positive when you factor in the share buybacks that they are doing. That seems to be on a continual basis until March 2027. Free cash flow per share, very, very important to note. It has been increasing over the longer term, over the last 10 years. 984 in 2014, 63.10 in 2023. Expected fairly flat into FY24. Nonetheless, moving in the right direction, a very positive sign. And for those that are new, we typically don't tend to talk too much about the earnings. It is susceptible to manipulation by management through accounting, but the data is always available so you can see on screen. Now, one of the issues that I do think about Alibaba that does need to be taken into consideration is the increase in their top line. Now, when we took a look at it, there was some very sharp growth, and we can just remind ourselves in terms of the revenue over the longer period. They had some very sharp growth over the last 10 years. It did decrease in 2023. So the question I would ask yourself in terms of looking at your investment thesis, can they continue to increase their top line double digits as they have done from 2014 to 2022, although we do know that it is slowing down. 2023, the first year, in fact, an increase of only 2%, where for more mature companies, we do look for a baseline of 3 to 7%. Now, numerically, they have grown very rapidly over the last 10 years, but ask yourselves again the question, can it continue? Shares outstanding. Now, over the longer term, we do in fact note net dilution, given that in fact they had a lower amount of shares outstanding in 2014 than 2023. But one thing, as we mentioned, they are now looking at doing a large share buyback across the next few years. So we would like to see this number come down and return a lot of that excess cash that they do hold on their balance sheet to investors. ROIC, now we want to see a minimum of 10%. For me personally, this is what I use. Gives me faith that management are able to effectively allocate their capital. And what we can see over the longer period, they haven't managed to maintain that, but we do see some consistency around 8 to 9% over the last few years, something I would like them to increase just a little bit higher. Now, operating margin and free cash flow margin, a very similar story to be told. We know inefficiencies in the margin on the operating side. It's decreased from 50% highs in 2014 down to 11-12. I want to see personally a minimum of 16%, which we have seen in 2019 and before then, and 2020 in fact, but it has started to decrease. It does mean that there is less chance, or it does reduce the chances for that bottom line to be higher the lower the operating margin. So something just to consider. Free cash flow margin as well, we do note it is decreasing. Nonetheless, still well above the minimum 7% we like to see. So very strong, but again, do keep an eye on all of these margins as they do seem to be in a downward trend. Something that maybe they are struggling with to keep up how they were performing not too long ago. Now, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, this signals 1, dividend safety, and 2, balance sheet strength. 0 every single year, absolutely no issues with their dividend, no issues with their dividend strength. And we can see here, very, very healthy balance sheet. Now, before we jump into the valuation, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles that we have all completely free, do click on that pinned comment below and you can sign up instantly. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, jumping into the first model, we have Graham's valuation, the stock ticker symbol BABA, the earnings per share, long-term growth rate, and the AAA corporate bond yield. To give an intrinsic value showing signs of undervaluation, our first signal, but do bear in mind we don't look at any of these models in isolation. We then have the multiples valuation model, companies in a similar sector and size, average P multiplied by the EPS of BABA. Again, we have a second undervaluation signal. We then move on to the third model. Now, typically the dividend discount model, we would use the yearly dividends. However, given the fact that they've only recently started to pay, we don't see this model to be too relevant. We then move on to the discounted cash flow model. Now, we have the free cash flows year on year, average growth rate 29%. Forward looking, now we've gone extremely conservative. We've gone at 0%, assuming that they don't manage to grow their free cash flows. It does maintain. Factoring the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and this gives an intrinsic value of $206. Bear in mind, this is on the basis that their growth rate is 0%. For example, if we were to put 4%, we can see this would go up much higher, but we want to be a lot more conservative on this company in today's episode. So at 0%, we have a 206 DCF price. Now, the intrinsic value in today's episode is just the average of these three scores, coming to $126. Do bear in mind you can click on the pinned comment below to grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. Margin of safety, as always, we use 10%. Remember, we use that if it meets 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price, and we can see for today's episode, Alibaba does hold a significant MOS. In fact, not quite 45%, but between 40 to 45%. And I would be interested to hear your thoughts as investors or potential investors at what MOS level you would use for a company like Alibaba, where there is also regulatory risk as well as geopolitical risk. So let me know below if even 40% doesn't entice you to this company. In terms of Wall Street and their forecast, well, they see a price target of $110. They see upside of 53%. They do see this as a very strong buy now. In fact, their price target does mean that you are looking at a very healthy return, not just on the share price, but also locking in a fairly nice starting yield, which I do believe will only increase given the fact that their payout ratio is sitting at around 11% for the free cash flow. And they are also doing a lot of share buybacks, which they have said will continue over the next few years, returning a lot of cash to yourselves as investors. However, as I mentioned before, a lot of investors may not like this, and they do see the risk with investing in a company in China. As always, though, do let me know, is this a company you're looking to invest in? Maybe not. Maybe it's on your watch list and you're waiting to see it turn around for the share price to increase before entering, or you're just dollar cost averaging in. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.